$100 today can be, a million tomorrow, it could be 500,000. We've seen this with, the NFTs going wild and the like. That price is determined by short-term supply and demand, and it can go wild.
My name is Kevin David, and if you want real financial freedom for yourselves and for your loved ones today, then the time is now. And I will be there to help you every step of the way. What is up, guys, and welcome back to another exciting episode of your favorite or soon-to-be favorite podcast, The Kevin David Experience. Today we have a very special guest joining us, which I know I always say, but it's because it's always true. So today, before we get started, I wanted to give a big shout out to everybody who's leaving us reviews on iTunes and watching the podcast on the new YouTube channel. So thank you to everyone. So today we have Brian Barnes, who's joining us from Chicago or Utah or somewhere. So Brian, the first question that we ask everyone is to summarize your entrepreneurial journey all the way up until right now in 60 seconds or less.
Okay, so I started my company M1 Finance about 6 years ago. I would describe it as 4 years of pretty steady growth. We went from myself around a kitchen table to about 40 people 2 years ago. And then in the last 2 years, we've sort of exploded. We now have 300 people working at the company. 2 years ago, we had raised 25 million. In the last 2 years, we've raised an additional 300 million. And what M1 does is creates a personal finance platform that combines the best of digital investing and digital banking into one comprehensive application. A lot of the genesis for the idea started from my personal finance nerdum, and I was a nerd from a young age in respect to finance, and really created the account that I wanted, and went from just chipping away at it to now we have a company that manages over $5 billion on behalf of 500,000 customers.
That's crazy. So how do you, I know this is an oversimplification, but how do you go from sitting around a kitchen table, right, without, much of a reputation or any reputation, right, to convincing people to give you $5 billion?
You chip away at it each and every day for 6 years. Yeah. So, it's, starting the company is interesting because, something in financial services is not something that you can do with two people in a garage. That, we started with an investing platform, and to become an investing platform, you have to become a broker-dealer. And the broker-dealer application process, you're regulated by FINRA, you're regulated by the SEC, and it's about a year-long application process. And so, it's a little bit of a unique company to start, especially as the first foray, where we did have to raise a bit more money early. We had to prove capital to the regulators, and we had, our first hire was a general counsel with 15 years of experience. This wasn't the grab a coder out of boot camp or college type thing. And so we started with a team of 6 or 7, quickly grew to 15. We were really heads down focused for about a year as we went through the application process, building the product. And then it was, each and every day just trying to add new features and new functionality, trying to grow the user base, have our user base advocate on behalf of us to sell their friends. It's really just been a compounding engine over the last 5 years since we launched.
It's interesting too, because normal not normal, but traditional startup advice is the exact opposite of what you just described, basically, right? You basically for an entire year raised a bunch of money and built a product without knowing for sure if someone was actually going to want it, right? Which is basically the exact opposite of what Paul Graham and many other kind of thought leaders in the startup space suggest. How they talk about making a prototype, an MVP, getting feedback and customer, what's your opinion about that? Because turning the kind of traditional startup advice on its head obviously has worked out very well for you, but many others probably have failed trying it.
Yeah, for sure. I think, there's sort of two schools of thought, and you have the innovate fast, that's sort of like Eric Ries's lean startup. And then you have, I'd almost describe it as the Keith Rabois model of go in a dark room, perfect your product, go out and sell it. And I think both can actually work quite well. It's something that if you look at other industries, when people write a book, sure, people are looking at the book, doing proofreading, but the first time that it's printed is really the first time that the audience is reading it, or same thing with a TV show or movie. You can get feedback and the like, but it's really the final product which you're showing off and really broadcasting in full effect. And I think that's a little bit more what you have to do in financial services. It's also the MVP, what like classifies as the bar of an MVP, just changes dramatically based on what industry that you're in. That if you're sending, a messaging app, if you lose a message, it's annoying, but it's not the end of the world. For us, we're in financial services. If we lose a login account, if we credit you a penny that you don't deserve, we've lost all of your trust. And so it's just the bar is significantly higher for what truly classifies as an MVP. And so it's just you have to build towards what the MVP is in the traditional sense. And then you will still iterate over incredibly long periods of time using customer feedback. I do think that a lot of startups would be successful if given enough time and energy to pursue their original vision. And I do think that sometimes they sort of over-optimize on short-term metrics that lead to traction as opposed to sort of getting over the hill and, bringing out a more robust version of what they originally planned, which was just an MVP of a higher quality that would resonate with their user base.
And then, I think I probably know the answer to, or your answer to this, but like, what's your opinion on starting a business? Because like, for example, starting M1 Finance, there's a huge amount of hurdles, right? FINRA, the application process, the broker dealer, everything that you described, right? The complexity and money required to build like a full product without ever, actually getting feedback, right? So that's like very hard, like on the scale versus starting like your example, a messaging app is very easy, right? And there's kind of pros and cons to each. The pros is, because it's so hard, there's a lot less competition probably, right? But, then the con obviously is that it's so much harder that, most people fail during that process.
Yeah, I don't know what the answer you thought I was going to say, but I think both can be massively successful, and I think it takes two different personality types to be interested in either that. I think, truthfully, I benefited by sort of having naive optimism when I started the company, that if I knew how hard it was going to be, I might have thought differently and not taken an ambitious swing in financial services. Yeah. But, I think it's like you mentioned, financial services has been protected by the rules and regulations for an incredibly long period of time. And therefore, the innovation that we see in every other consumer application experience has not infiltrated financial services to the same degree. You're only seeing that now with the Robinhoods, the Affirms, the M1s of the world, sort of coming in and saying, hey, we can create a consumer application on par with all the consumer applications out there. It is additional hurdles. It is like the reason why consumer applications outside of finance are better than the ones inside of finance is they're the lower hanging fruit. You can get to them without having to go through the hurdles. And so, like you mentioned, I think it's really more of a trade-off. It's a people went after the low-hanging fruit first, and now the areas that have the most ripe opportunity for disruption are the ones that have had bigger struggles or bigger hurdles to get into over time.
So how does someone with no experience, right, start investing? Are you more so on the Warren Buffett side of thinking, or is it ever the right decision to YOLO on Dogecoin?
I will be anti-YOLOing on Dogecoin. So I think there's a huge difference between trading and investing, and they all start with the same thing. You're buying a stock, you're buying an asset. The difference is why you're buying it and the length of period that you're holding it. And if you're trading, you're saying, I'm buying it now because I think 3 hours from now someone will buy it for me for more, or 3 days from now they will. And at that point, it's actually sort of independent of what the underlying thing is, whether it's a company, whether it's a Dogecoin, whether it's a crypto, whatever asset class. It's really driven by the short-term supply and demand and whether you can, predict that correctly. Versus investing is buying ownership stakes in things because you think the thing is going to become more valuable over long periods of time. So when you buy a company, you think the company now over long periods of time in itself will become more valuable. It'll have more intrinsic value over a long period of time, and therefore it will be priced higher in the future. And so, there's a huge difference of, hey, I'm playing the price movements, the short-term price movements, versus I'm buying the fundamental value of the entity itself, and that's going to increase over time. And my perspective, the way that we've built M1 is always geared towards the investing mindset of buy things you know and understand and think are going to become more valuable over time, and do it systematically over long periods of time.
So can retail investors beat the market?
I think they definitely can. I think it's incredibly hard to do. I think that debate gets a little bit too granular because, most people are not out there. Like the biggest determinant of your net worth, your financial health, your financial well-being is not going to be whether you outperform or underperform the market by 30 basis points or 2%. It's going to be whether you contribute 1% of your income to investments and savings at any given time or 20%. And so when you're talking about, that as a 20 times order of magnitude difference of, savings and, habitual things, the habits that you do in terms of money management matter significantly more than, outperformance or underperformance of your underlying portfolio. And it's one of those things that having choice and selection and active participation in your portfolio gets you to contribute more. It actually has you creates more ownership, more buy-in, has you understand more. And so the notion that you just throw it over the wall into a passive portfolio, if that causes you to contribute less or to be less involved in your finances, you're going to be worse off on the whole, even though you'll have market beta return.
So do you have a rule of thumb? And I know people don't necessarily usually like giving these, but do you have a rule of thumb that most people, maybe they have $100,000 they're looking to invest or 10,000 or whatever the case may be, right? I've had other, successful entrepreneurs and folks on the podcast before that have given me kind of how they like to organize their investments, X% in real estate, X% in the market. Do you have a kind of rule of thumb like that, or how do you think about that?
So, I have to be a little careful on giving recommendations or investment advice just due to the industry that we're in. The first thing is I actually look at financial health or well-being sort of holistically, and so it's not just how you invest money, but it's also how you spend and borrow and make money. And so I'd say the foundations for investing is really teach and educate yourself, build up the skills so that you can make more money. That sort of is your revenue on a daily basis. Spend hopefully a decent amount less than you make, and that puts you on a glide slope to financial well-being where you have incremental savings every 2 weeks with your paycheck as it comes in. And then I would say on the excess on the investing, it's invest in a diversified portfolio of the things that you know and understand. I think there are I think when you're younger, having higher risk assets, and so, if we sort of start from the basic advice of 100 minus your age in terms of the equity bond ratio, I think that's actually probably good enough for most people. It's whether you want to tinker and optimize and, get more involved and learn more at a time, and that's sort of your expansion. And I think you can do better than your 70-30 or 80-20 equity bond portfolio.
Right.
But I don't know if there's a universal one-size-fits-all portfolio for anyone in terms of, here is the perfect idealized asset allocation for any person, regardless of their age, their risk tolerance, their wants, their needs, their, are they preserving capital? Are they growing capital? I think it's really, really unique to the individual.
So what would you say to Mark Cuban saying that diversification is for idiots?
So I think he's somewhat backtracked on that because he also says, throw all of your money in the S&P, ETF and the like. And so I think Warren Buffett has a somewhat similar quote. It's a little bit less harsh. It's well, I guess it's actually quite as harsh. It's diversification is for people who don't know what they're doing. And it's one of those things, if you have knowledge and aptitude and you like it, I think you can benefit by having active selection. But that active selection shouldn't be, I heard it on Twitter or, this TikToker mentioned this thing. That's not enough basis. But if you've done the homework, you've done the skills, you can put it into things that you know and understand, and that will give you more confidence and more comfort to hold that investment for long periods of time. I think it's perfectly acceptable to say, I hate finance, I don't care, I want to just sort of, in a sense, ride the coattails of other people who are doing the pricing equation and just minimize costs as much as I can and put it in a passive portfolio, and you will get very strong returns. You'll probably you'll probably beat the average. I do believe that, the average passive investor will beat the average active investor. And so, it's one of those things that by doing less, you oftentimes achieve more. But I also don't think that means that you shouldn't have the opportunity to make choices in your financial decisions.
So what are the things that you like to look at when you're evaluating a company, right? If you're looking at Apple, you hear about price earning ratios, you hear about balance sheets, you hear about all these things. For someone who's just starting out and investing, what are some things that you personally, with your experience, like to look at when you're kind of taking a look at different companies?
Yeah, so I actually always start with more of the qualitative versus the quantitative. I think the qualitative, when you're buying a company, what you're doing is you're buying a residual income stream of what that company will earn from now until judgment day. And so the qualitative stuff of what is that company doing now, what will it do into the future, how will it compete in this world, and the story that you project into the future is actually much more important than the sort of algebra or math that goes into the quantitative assessment. And if anything, the quantitative stuff is like easier, but it all comes after the qualitative assessment of how is this company going to perform in the future. And so I like to look at, what is the company doing? What is the competition? What like fundamental need is it serving? Does it have any of that sort of like universal defensible moat aspect of things that, it's going to do well in a lot of different environments, regardless of how it's managed, just because of the product or the service or the competition or some fundamental intrinsic values of the company. And, sort of looking at the past, how has this company developed and what does that likely mean for how this company will project into the future? Once you get that, you sort of have your story of, what is revenue going to be? What are margins going to be? What is the total addressable market and how much market share are they going to have? And then it is you can run like that math equation of, hey, what is the discounted, cash flows of this business over long periods of time? But I think the story and the fundamental, like the picture that you're painting is actually much more important than the math. The math is just a representation of that story you're telling yourself anyway. And so I think the qualitative is the first place to start with any investment.
Yeah, no, I like that too. I mean, one of the rules that I use for myself is, don't ever buy anything that you wouldn't be comfortable holding for 10 years. And like that kind of forces you to evaluate like anything that you personally would buy like through a different lens. And so like what I would recommend to all the listeners who are here is, create some sort of like investment thesis for yourself where you have like rules that you'll feel comfortable with, because there's always going to be a roller coaster, right? Today's September 7th, Bitcoin is down like 25% randomly for no reason, right? Or for like no discernible reason. But if you believe in Bitcoin and its utility, right, and the story that you tell yourself and project, over like a 10-year lifespan, then you won't be like emotionally devastated by like the kind of short-term losses. And if you're just starting out as an investor and you've never experienced that, trust me, it does get emotional when you lose, thousands or hundreds of thousands or millions of dollars in a day. And so you want to be, kind of prepared for that. So one of the other things that Warren Buffett says, Brian, is he talks about the number one rule of investing being never lose money. Right. So like, what are the tactical things that M1 does or that an investor can do to kind of, minimize their downside?
Yeah, you were talking about it a little bit before that, using another Warren Buffett quote, he says that price is what you pay, value is what you get. And it is one of those things that price can be anything in a short time. It can be $100 today, it can be, $1 million tomorrow, it could be 500,000. We've seen this with, the NFTs going wild and the like, that price is determined by short-term supply and demand, and it can go wild. Versus value is more of a fundamental thing. It has, like a home has intrinsic value because you can sleep there, you can, raise your family there. Where it, if I live in a home, I don't care what people are pricing it at any given time because I sort of know the underlying fundamental value. And so I think, if you're trying to say, hey, I am buying true value and I'm paying a reasonable price for it, or have, some margin of safety associated, hopefully paying less than what I think the true fundamental value is, and I think that value is going to increase over time, it's very hard to lose money that way. And so, like buying true substantive value at prices lower than, what the true value provides, it's hard to lose money over long periods of time if you're doing that.
Right. And then, yeah, the margin of safety aspect, I think, is a really important thing that Warren Buffett talks about as well, where, essentially what he's saying is if you have like some sort of margin of safety, and one of the best kind of metaphors that I've ever heard for me personally is, Charlie Munger's example, who's Warren Buffett's partner, of being a spear fisherman. I'm sure you've probably heard that one, but just to me personally, it makes a lot of sense. And kind of the thesis in a sentence is that Berkshire Hathaway, right, their parent company, sometimes will wait years to make a single investment. right? And the reason that they do that is because they wait on the edge of the river as a spear fisherman, waiting for the correct moment to strike with everything, right? And you'll see them, deploy billions or tens of billions of dollars. And obviously that's a different scale than, everyone basically else. But it's a really interesting idea how if you're patient, you're generally rewarded for that patience, but you have to be ready to strike right when that time actually comes, which is something that I think is important for me and other people to understand. So what is your opinion about timing the market versus time in the market, and do you buy into the spear fisherman idea of waiting for a coronavirus pandemic sort of thing to happen and then kind of going all in?
Yeah, so I think I'm going to talk about somewhat conflicting advice that I do believe time in the market versus timing the market. And so, I think that it's very hard to predict with any certainty of what's going to happen in the short term. And it's one of those things that having money working for you in assets that are appreciating in value over long periods of time, like compounding in time, is your best friend in investing. And so almost all of the time you want to be fully invested in things that you think will appreciate over long periods of time. So, I'm definitely like a time in the market perspective. That being said, I think there's like counter thing to human psychology that as things go up, people get more excited about it. They're, if it goes up, it's going to go up even further. And as things go down, it's the inverse. It's, oh no, it's going to fall forever. And really what you see in pricing an asset is, to get to that underlying value, the value likely hasn't changed all that much. And so actually, as price goes up, it's a riskier asset because you're paying more for it. As price goes down, it's a less risky asset. And so, I think that there is a counterintuitive perspective that, as you pay more, it becomes a riskier asset. As you pay less, it's a less risky asset. And, having that in your mindset as you evaluate opportunities and the like, it's not to say things that have gone up are overvalued or things that have gone down are undervalued. It's just to say you shouldn't chase things that if they go if you like it today and it goes down, it's on sale. If you like it today and it's gone up, it's more expensive. And always taking that mindset as opposed to sort of chasing price momentum.
Right. Yeah, I love it. So first of all, you are an incredibly articulate person. I feel like I could have a conversation with you forever about finance, and people listening would still love it. So if people want to learn more about you personally, if you like to have people reach out, or if they want to learn about M1 and sign up for their account, can anyone get started with M1? Do you have to have certain things? How does somebody who's listening, start investing with you guys?
Yeah. So M1, we're a investing account, a checking account. We are, if you go to m1finance.com, that's our web application. We're native in both mobile Play Store, so the App Store and Google Play Store. We're one of the highest rated personal finance apps out there. Have more than 500,000 users, $5 billion on it. We publish newsletter, a blog. I write a lot of those, and so that's a lot of my thinking on personal finance and investing and the like. I recently signed up for Twitter. I used to be a 7-year lurker on Twitter, but I'm now supposed to be active on that, and so I think my username is Barnes_M1. So you can see my one tweet there, but I'm sure there will be more over time. But yeah, that's probably the best way to follow what we're doing.
Awesome. Well, thanks for joining, man. I really appreciate your time. I think a lot of people learned a lot about, investing and good ideas. And, if you want something that's fully hands off, maybe M1 Finance makes sense for you guys. So appreciate your time, Brian. And if the people demand it, could we have a round 2 someday?
Absolutely. Would love to join again.
Thanks, man. Appreciate your time.
Yep. Have a good one.